Peter Lynch was one of the greatest money managers in history. He averaged 29% annual returns for 13 years. Now, 29% is not the compounded annual return, it's the average return. And he averaged that for 13 years with the Magellan Fund. And the reality is, the average investor in that fund lost money. It's not a typo. That's information from Fidelity itself. And Magellan was a fund at Fidelity. Returned 29% for 13 years. How does that happen? And we're going to get into that. And when we do, I think you're going to recognize someone you know. It could be yourself, or maybe it's someone else you know. I shared that story about Lynch with a client some time back. I told him the statistic that the average Magellan investor lost money. And he went quiet. He went quiet. And then he said, I was one of those people. He'd owned Magellan. He'd invested in the fund. And he'd done exactly what most people do. When the fund dropped, he sold. He couldn't take watching it go down. Told himself that he'd get back in when it was up again, when things settled down, when it was safer to do. So he waited. And when the fund recovered, when it climbed back close to new highs, he bought back in. Felt better. It was safe. The chart was going up. The fund was making money. He was making money. And then it dropped. And he sold again. People do that all the time. They buy high, sell low, over and over again. One of the greatest performing funds of all time, and the average investor lost money. The fund didn't fail. The emotions failed. Nobody warned him that would happen. Peter Lynch said it plainly. If you can't convince yourself that when your portfolio is down 25%, that you're a buyer and not a seller, if you can't hold that belief and act on that when you're down 25%, be a buyer, not a seller, you never have better than mediocre results. It's not a criticism. It's just a description of human nature. We're wired to avoid loss. We're wired that way. We feel pain when things go down. Part of our brain that says to run is not broken. That's just survival instinct. But survival instinct is not investment strategy. The founder of Vanguard, the late Jack Bogle, said in his 50 years of being in this business, he had never known anyone, nor had he ever known anyone who knew anyone who consistently outperformed the Standard & Poor's 500 by trading in and out. 50 years, not one person. And yet, when the markets drop, people do the instinctive thing: sell, move, protect, react. It's almost impossible not to. It's irresistible. To do otherwise, for most people, is really difficult. And I want you to hold that thought, because it's going to come back when I tell you about Herman and what he went through in 2007 and 2008 when his accounts were down, and I was actually uncertain that he would ever reach the goal that he set. Now, Herman, I'll tell you about Herman. Herman's story. Herman didn't come to me directly. Nothing in this business ever seems to work directly. Herman's story begins with Gary. Back in 1987, when I was a brand new financial advisor, a stockbroker, there was a financial advisor, a stockbroker, who left the firm I was with, and I inherited one of his accounts because they were passed around. It's something that happens when brokers leave. Their accounts get passed out to other people, and the other people try to keep the funds there. And his account, I was new. His account was small. It was like $15,000. Wasn't huge, but I kept Gary at Payne Weber, the firm I was with. And at that time, I was I was new, and I would take anyone that I could take as a client. If they could fog a mirror, they were my client. But soon after I started working with Gary, he got married. He got married to Nancy. Nancy had her own account. And after Nancy saw what I was doing with Gary's account, she moved her account to me. So now I had Gary and Nancy's accounts. And few years passed, and Gary and Nancy got a divorce. And it was not the friendliest of divorces. And they not only fought over almost everything, they fought over who would get to stay with me. I thought that was funny that I was that desirable. Um, but they agreed they would not keep their accounts both with me. Nancy won the argument, and Nancy stayed with me. Gary moved on. A few years passed, and Nancy remarried. Nancy remarried Herman. That's how he came into the picture in the mid 1990s. Herman had roughly 200,000 at the time. He was still working, still had a pension plan, still had his Social Security that he could draw on once he retired. Had 200,000, thought that during the time he was going to continue to work, he could add another 100,000 to his account, so he would have 300,000. And he wasn't planning to draw from the account at all, just wanted them to grow. Nancy passed away after about 10 years of being married to Herman. She passed away early in the century, and Herman inherited her house. And when he eventually retired, he moved to Nevada, and everything changed. He bought a home there. He used money from his accounts, some of his accounts that had grown. He used some of that money to not help purchase, but put the down payment down and to make payments on that house. And he realized he was going to need not 100% of what he needed when he was working. Back before he retired, he felt that he was going to have 80% from his Boeing pension and another 20% from Social Security. He was going to have 100% of what he needed. When he moved to Nevada, he realized he needed more than 100%. He needed 110 to 130%. He needed to draw down principal, draw down a steady income stream from his account with me. That changed a lot. That changed the math. And when that happened, he told me what he really wanted, what his real goal was. Herman, starting with 200,000, wanted to keep his quality of life, but he also wanted to leave $1 million to each one of his three daughters. He wanted to leave his accounts to grow and his holdings, his net worth, to be $3 million. And during about that time, Herman was cold called by another financial advisor who offered him a second opinion on his investments. And Herman said, okay. Herman had talked to this financial planner a number of times, said, okay, make a plan, show me what it is. And this was around 2006 or 2007, just before the crash. The advisor was credentialed, his plan was well designed, had a growth focus, proper asset allocation, proper diversification according to financial planning. And the plan showed clearly there was little to no chance that Herman would ever be able to give each of his three daughters $1 million. He was never going to be able to reach $3 million in assets. Clearly. And Herman shared that conversation with me. And I said to him, what would you expect? Would you expect the other advisor to say, wow, Mike's really done well for you? I can't do that well. Of course not. That's not how it works. The other advisor needed to plant doubt. I've had other clients who have actually moved their account to financial advisors because the advisors say stocks are risky, too risky. You can't afford the risk. You know, it's not a professional failing. That's their job. When someone's trying to when they're trying to open a new account, they want to clamp down, and they do sometimes. That was what the advisor was doing for Herman. And the fact is, financial plan is only as good as it's built. And if you listen to one of my past podcasts, you know why the math will never add up in a financial plan to give the returns that you get from my clients. You know, Herman stayed with me. He didn't move to the financial advisor, and then the Great Recession arrived. 2007, 2008, the beginning of 2009. Even I wondered if I was wrong, if the other financial planner had been right, that he wasn't going to meet his goals. And I had concerns. And I thought about Herman at that time. I wondered. I kept asking myself more than once, was his goal really impossible to reach? Was I going to be wrong? It was a time in which most clients were calling their advisor. They were nervous. The markets were nervous. The markets were terrifying during that period of time. I have to say, I had very few client calls, and most of the client calls were asking me how I was surviving that tough time. During that time, Herman never called, not once. Not during the whole of 2007, not during 2008, not when it looked like the whole thing might unravel. Herman never called. Herman died in 2016. And when Herman died in 2016, each of his daughters inherited over $1 million. His account, even though he'd been drawing money to buy the house in Nevada, even though he had been taking a monthly amount out of the account, his account that had started at just under 300,000 had grown to 1.7 million. The houses, the house in Seattle, the house in Nevada, were worth another $1.3 million. His account, he was able to leave $1 million for each one of his daughters. Something that the other financial advisor in 2006 had said, absolutely impossible. Never going to happen. Herman had lived through the dot-com bust. He lived through the Great Recession. Herman had seen his accounts go down, but he hung in there. He didn't move. And that's why I want to come back to the story about Peter Lynch. When I talk about the average investor, seeing a fund like the Magellan Fund up an average of 29% a month, and the average investor losing money, the fund was never the problem. Time was never the problem. The enemy was the belief that you had to do something when things were down. Watching was never enough. Looking at the long term was never enough. Looking at the potential returns was never enough. It was a tariff. When you go through a terrifying time, it meant you had to do something. That's the wrong thing. You know, Herman understood the lesson for today. He understood the thing that most and a lot of investors never learn. I'm not going to tell you that every story ends the way that Herman's did. I can't promise you that. Nobody can. But I can tell you that every story that ends badly, that I've heard about, usually ends badly because investors make improper moves. They get scared. They get fearful. And it's a human emotion. It's sometimes the saying is the best investment time is when you're hanging onto the chair so tightly that your knuckles are turning white. When it's that fearful, when it's that time. You know, that's the story for today. That's the lesson for today. You know, most people, I always say, as we end these times, you have three choices. You can do nothing and hope that this time is different, that this time there won't be any downtimes, or when there are downtimes, you won't feel the fear, the panic. You can do nothing and hope that by selling out, you can get back in at a lower price. You know, it doesn't happen that way. If you're invested in the right things at the right time and have a long-term outlook, that works out. And it's not just being in a financial plan where the planner says, just hang on, things are going to work out. Because I'm going to talk next week about things that don't work out. Hanging on did not work out in the 1970s and 80s. And I believe we're coming to one of those times again, doing nothing and hope that it's going to be like the dot-com recovery, that it's going to be like the COVID recovery, like it is the Great Recession recovery. Doing nothing and hoping is probably a very losing strategy for what's coming. And that's next week's program. So don't miss that one. The second choice you have is to wait until the evidence is undeniable. When things are really down, and then you do something, then you begin to think about the long term. When you're already in a tough position. I remember talking to someone, it's been a long time ago, and I never followed up, but he came to me and he said, things are down right now. I need to make some changes. I need a 30% per year return. I said, 30%? I said, good luck. I can't do 30%. I don't know anyone that can do 30%. The time to react was long ago before the things were down. The time to make the changes were before. 30% return per year over a long period of time is not going to happen. The third choice you have is to begin to prepare now. For my clients, I've been preparing since 2016. I was really, really early. But I could see in 2016 we were coming to a time where inflationary forces were beginning to build. And we did have a run. We did have a run in 2019 and or 2000, not 2018, 2021, 22, 23, 24. We did have that. But the forces have not gone away. The inflationary forces are still there, and they're probably going to get worse. It's not just the price of gasoline that's increasing. It's the prices at the grocery store. It's the prices of imports. And for those people that thought tariffs were a one-time deal, and once the people were accustomed to the tariff increases, that inflation would settle down again, that's not happening. Inflation is slowly creeping up, and inflation is one of those things that doesn't go from 3% to 10% overnight. It's something that creeps up year after year after year. And at the same time, there are so many signs that we're into a recession. And the forces are there for a recession and inflation at the same time. That's called stagflation. Been preparing clients in 2016. It's not too late to continue to prepare, to do it calmly, to do it deliberately. That's what I suggest. My question to you, if you have a financial plan right now, if you have a financial plan, it's probably going to show with Monte Carlo simulation that you have a 93% chance of having enough money. Number one, there's a mathematical problem with that. But disregarding that, even if that was accurate, what about the 7%? Do you ever consider that 7% or 10% or 3%? You don't make enough that your account and your net worth is not going to hold up. It's real. When they say there's a 10% chance of rain, sometimes it rains. You know, with your account, if it's saying that you're not 110% positive, can you think about that? Do you think about that? A financial plan makes most people feel really good, makes them feel like they're going to to do well, we only have to look back at 2007 and 2008 when a lot of financial plans fell apart. It wasn't that their plans were 7% at risk or 10% at risk. Plans that were 88 or 98 and 99% sure suddenly fell apart. If you were in that time period, you can remember the talk was about fat tail distributions because financial plans didn't hold up. It left people with a lot of problems. And that's what we're going to be talking next week. But right now, you can prepare now calmly and deliberately. Take some time. Check the chat box, check what's on this video, and make a 30-minute appointment with me to talk about your goals and your plans, where you are, and I'll give you an honest assessment about what I think. And that brings us to the end. So with that, let me ask, are there any questions that you have?
Hey, Mike, it's Chris. I'm back, and I have, just bear with me one moment. Mike, somebody asks, what's the single biggest mistake you see retirees making during a downturn?
The single biggest mistake right now is that I've seen over the past is for them selling out and getting fearful of what they're going to receive. For most financial plans set an income up, and when the principal goes down, the income is reduced. Whether they set aside a 2-year amount of money to go, replenishing that becomes an issue. We've set a steady income stream during good times and bad times. That's what we do differently. Selling too soon. But I believe, and we're going to talk next week about that, that's not going to be the biggest issue going forward. The biggest issue is not understanding the impact, the long-term impact
Mm-hmm.
of stagflation and market-wise. John Templeton said, bull markets are born on pessimism. They grow on skepticism. They mature on optimism, and they die on euphoria. And what I'm talking about are not just the conventional idea that corrections are down 10% and bull markets are down 20%. I'm
Mm-hmm.
talking about secular bull markets, secular bear markets. The bull market that started in 2009, coming to an end in the late 20s, early 30s of this century, like the bear market that happened from March of 2000 to March of 2009. That was a secular bear market. Market was 11,000 in March of 2009. By March of 2009, by March of 2009, the Dow was at 6,600. It had lost 35% over a period of 9 years. That's a real bear market. It bounced up and down, but it just didn't go anywhere. I believe that's the time we're headed into, and that's next week's program. So, and
Mike, somebody asks, they're asking, does someone need to announce officially that we're in stagflation, or is it just a condition like the weather and you know you're in it?
it's a condition.
Yeah.
There's no official pronouncement. It's something that people come to the conclusion we're in stagflation. So there's no official announcement at all.
Mike, follow-on question. What does a portfolio that's prepared for stagflation look like?
It's not going to have, well, it depends upon the goals for the person. It depends
Hmm.
upon their income needs. It depends upon their particular situation. I can't say that there's one model. I can say that annuities don't hold up, that bond funds don't hold up, that fixed income can be used in stagflation and create positive impact, but it's not a laddered type portfolio. It's not a buy and hold type situation. Um, and the things that do well, actually, in the last stagflation, real estate held up, residential real estate held up, and commercial real estate. And if you think that we're underbuilt at this time as we were at that time, real estate could do well. I have a feeling that the demographics have changed dramatically from the 1960s, that young people today are not the same view as we had in the 1960s and 70s. And I'm not sure that real estate will hold up.
Mm.
Commodities will have their bounce up and bounce down. But even in bull markets, commodities return zero over the long term.
Hmm. Hmm.
It's being in the right and a few right stocks that gets the portfolio going. The stock market doesn't do well. But there are always in stock market times, there are some companies that do really well and their stocks do really well. It's being in the right place at the right time. That's what I'll say.
Mike, that wraps up the questions that come from the audience. You've already answered my weekly question of what's going on next week. And so I will let everyone know that happens to be watching this live in the chat. I have put two links for you. One of those links goes to our YouTube channel, which is About Money Radio. And when you go to that channel, you can watch replays of all of these broadcasts. If you find value in what you watch, I'd love it if you would give us a subscribe. That helps us surface with even more people. And if you know someone that could use this information, you could share these videos. We'd appreciate that. The other link I've put into the chat is Mike's email address. And if you want to schedule a 30-minute appointment with him, it's mike@adamsfinancialconcepts.com. For those watching the replay, I'll make sure that link is in the description. Mike, with that, that wraps us up for today. I'm going to hand it back over to you for the final word.
Well, thanks for being here. And thanks for watching this workshop and podcast. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. I think we're in the last chapter. And that chapter lasts for years. But that's a time to really prepare for the death of a secular bull market and entry into a secular bear market. So join me next week. I think it's going to be a very, very important program to hear. I think you'll really get a lot from it. And with that, have a very good week. And I will be back next week.